What I'm going to show you now is how the typical bank and broker formula works in relation to how people purchase an investment property. So let's take a typical example of a home that's worth $800,000 and the mortgage is sitting at $500,000. And you decide to buy an investment property, and the property be, let's say, for example, you look to get a $400,000 home. Now, you'll also want to borrow for the other costs that are associated with that, which would be the stamp duties, the legals, etc. So in the end, you need a loan of 420,000. Typically, what a bank or a broker will do is they'll get you that loan for 420, but what they won't tell you is that that loan, obviously being more than the property's worth, has been completely secured against your home. So that'll mean that rather than just having, in this scenario where you had 500 grand worth of debt, so once that 500 grams repaid, you own the home outright, you actually end up with effectively 420 plus 500. So you've got $920,000 that's owing on your home. The other challenge you've got with this is, let's say, for example, you lose your job. You decide that you want to sell your home. Your investment property's done its job. You paid 400 for it, including costs, you paid 420. It's now worth $600,000. In your mind, that means that you sell it, you pay the agent's costs, and you've got at least $150,000 to $180,000 that you can access. So you go off and you sell that property. The problem is that then you go to the bank and you say, well, I've lost my job. I want to tap the equity in this property. I just want to repay back the 420 loan. Because that loan has been completely tied to your property, it's not just a matter of repaying it from there. So quite often what they can do is they can actually hold on to a little bit of that surplus funds, and it puts the bank in control. It takes all of the control away from you. Now, the other challenge that we've got with this property is, as much as we'd all like to think that property goes up in equal increments every year, generally what we'll see with property prices is they'll go up, they'll be a little bit flat, they'll sometimes drop a little bit, and then they'll have the next growth surge. Now, when you've got two houses that are tied together, the bank is actually viewing that as one loan of 920 across two assets. Let's say, for example, your investment property goes up in value and it goes up by $100,000. But your actual home that was worth 800 grand, that drops in value and you lose $100,000. You've actually gained no equity whatsoever. It gets even worse in a really tough market where, let's say, for example, that dropped by 200,000. You've actually lost $100,000 of equity. In the previous example, we went through where the banks and typically brokers set up the loan and the pitfalls of it, meaning that your home is completely secured against your investment property. What I want to walk you through now is how our formula works and how it puts you in a position of control. So let's use the same example of a home that's worth $800,000 and it's got a mortgage sitting on it of $500,000, and you once again look to buy a $400,000 property. You're also going to need another $20,000 for costs, so $420 in total. Now, rather than just simply getting one loan for $420, which is quite a lazy way of doing it because it means it's less work for the broker, it's less work for the bank, and it wraps both securities together. How we differ and what we do is we'll actually take a loan down here and we'll secure it against your home for $120,000. Now, what that does is that acts as our deposit on the investment property. We then take the remaining $300,000, and that's completely secured in this example against this house here. So first version, you've got 920 grand that's stacked on both of the properties, including the home. This portion, we've now got 300,000 that's secured against your investment property. And we've got the 500 grand there. And yes, we've had to secure a little bit of the debt against your home because that's where we're getting our deposit from. That's where the 120 is there. And as you can see, that's obviously beneficial because it's reducing the amount of physical debt that's sitting on your home. Now, the key benefits from that, well, the first one, as you can see here, we've only got $620,000 worth of debt. But it's not just about the position now. We're looking at where this is going to take us in the future. As this property goes up in value across here, so today it's worth 400, in a couple of years it's worth 500, it then goes up to 550, we can actually shift this $120,000 debt across to this property, we can also access the equity. Other than the fact that now your debt is kept separately, so you've got your investment debt, is that you can actually shift this investment debt over time. So at the moment, the house is worth 400, but it's not going to be worth that forever. So let's imagine it jumps in value to $550,000 a few years down the track. At that particular point, this debt goes away. And all we do is we just chuck it across here. So you've got your 420, because at that particular point, the value of the investment property is shot up in value. It can now hold all of the debt, and that now protects your home. Now, the advantage is that this figure will be dropping in value. You eventually want to own your home. And another key benefit from there is that this formula allows you to acquire more investment properties at a faster rate. As I mentioned with the earlier example, if one of the property values drops and the other one increases, you minimize the amount of equity. When you've got the two of them separate, you can really take your pick, and that's part of what we do is we actually sit with you and we have a look at what's gone up in value and where we can get the equity from next. The other advantage that you have is that in the example before where you lost your job, you tried to get the equity out, it doesn't matter in this case. At any particular point, if you decide to pay back either loan, you either need to pay back the 300 that's owing or the 500 that's owing across the two properties, because they are completely separate. In fact, in a lot of cases for our clients, we actually go to two different banks, and that means you're completely insulated from one bank knowing about the other asset. Just following on from the importance of making sure that the properties aren't tied together, let's imagine we got the home, they've now bought the investment property, and it's 4 years down the track and they now decide that they want to get another property. Now, investment properties jumped up in value, homes dropped down. Let's imagine that's gone up by $80,000 and that one's dropped by $100,000. When we go to get the cash for the next property, where do you think we're going to get it from? Obviously here. That will allow us to take our deposit and get the next one. Now, if we had have gone with the typical bank formula, where the properties are all tied together. You'll excuse my drawing, obviously that's not my forte in life. I've got the properties all tied across there. We've actually lost 20 grand worth of equity. Now, if mortgage insurance had have come into play, which is where they borrowed above 80% of the property, they could actually potentially be unable to buy the next property, regardless of what their income is, because there's just no available equity. Whereas in this scenario, it doesn't matter about the fact that their home's dropped. We can still tap the 80K that's sitting there.